The Intelligent Investor, Chapters 11 to 13, Summary and Key Lessons. This video could be the most valuable 25 minutes of your investing life, or just background noise. The difference? Whether you use what Graham teaches. Those bold words capture how Benjamin Graham's The Intelligent Investor can transform your investing journey or bore you if you miss its wisdom. In chapters 11-13, Graham lays out an introduction to security analysis that shows how to evaluate stocks wisely, see through misleading earnings, and prefer solid value over market hype. Let's break down the powerful lessons from these chapters with a touch of storytelling and some eye-opening commentary along the way. Security Analysis 101, Graham's Common Sense Approach, Chapter 11. Chapter 11, Security Analysis for the Lay Investor, is all about how an everyday investor can assess stocks and bonds like a pro. Graham starts by warning that many Wall Street analysts were justifying sky-high stock prices with rosy far-future growth projections. In other words, they were using precise math on a very imprecise future, a recipe for trouble. Here's what most people miss. If those overly optimistic forecasts are even slightly off, the valuations implode and investors eat big losses. Graham found it alarming that experts were projecting endless growth to rationalize any price. His reaction? Instead of following that folly, do the opposite. Recognize this madness for what it is and resist the urge to join in. To ground us in reality, Graham says the intelligent investor should begin with the basics of a company's annual report. In plain English, learn to read financial statements. He even wrote a separate book on this skill. But you don't have to become a CPA, you just need to grasp what thoughtful analysis looks like, so you can tell sound analysis from superficial blather. Graham boils the process down to two core questions any stock picker should ask. 1. For bonds and preferred stock, what are the primary tests of safety? Can the company reliably pay interest or dividends? 2. For common stock, what are the chief factors in the valuation of this stock? What makes it worth a certain price? For bonds, analysts of Graham's era focused on past earnings and assets. Things like earnings coverage of interest, a minimum company size, a cushion of equity behind the debt, and asset values to support the debt. In short, can this company handle its obligations even in bad times? Graham notes how using such safety tests would have flagged many shaky railroad or utility bonds before they went bankrupt. Most people only saw high yields. Graham saw the red flags. For stocks, the analysis is a bit more forward-looking, but grounded in reality. The ideal stock analysis, Graham says, comes up with an intrinsic value for the business and compares it to the market price. How to find that value? Essentially by estimating a company's average future earnings, looking at several years ahead, not just next quarter, and then multiplying by a sensible capitalization rate, a price-to-earnings factor. In fact, Graham suggests a simple formula for growth stocks. Intrinsic value equals current normal earnings. Multiply that by the number you get when you add 8.5 to 2 times the expected growth rate. He recommends estimating growth over the next 7 to 10 years. This formula blew my mind. It basically says even the best growth company isn't worth an infinite price. If a company has 0% growth, then 8.5 times its earnings is considered a fair value baseline. For every additional percentage point of growth, you add a little more value to that multiple. This part blew my mind. Graham was quantifying hope and fear into a down-to-earth number. It's a reality check for growth chasers. Next, Graham highlights qualitative and quantitative factors to judge a stock. Some key factors that drive the appropriate price-to-earnings multiple include the company's long-term prospects, the quality of its management, its financial strength and capital structure, its dividend record, and its current dividend rate. If those sound like common sense, exactly. Graham is applying common sense questions. Is this business durable? Trustworthy? Conservatively financed? He advises gathering at least 5 years of annual reports and digging for answers to 2 questions. What makes this company grow? And where do its profits come from, now and in the future? This investigative mindset turns you from a stock gambler into a business analyst. Graham also provides a reality check on growth projections. When he revisited how forecasts from 1964 panned out by 1968, he found that, in aggregate, the analysts weren't wildly off. Surprising, right? But here's the kicker. While overall groups might be predictable, individual companies' forecasts were hit or miss. That's why Graham insists on diversification. Not even the smartest analyst can dependably pick one single winner every time. It's tempting to put all your chips on the one stock you know will triple, but Graham warns, nobody knows for sure, so spread your bets. Now, Graham's common sense approach to analysing a company also means watching out for danger signs. He gives examples of corporate behaviours that should make you sceptical before you invest. For instance, be wary if a company is a serial acquirer, gobbling up multiple companies every year. That growth by acquisition can be a smoke and mirrors game. Or if a firm is addicted to issuing new stock or debt, raising cash from investors instead of from profits, that's a red flag. The business can't fund itself and constantly needs other people's money. Another sign of risk is relying on just a few big customers. If one relationship cracks, the earnings could dive. Graham basically tells us, look for the cockroaches in a company's story before you buy the stock. On the flip side, he points out green flags of a high-quality company, those with a wide moat, strong competitive advantage, a steady long-term growth trend, a marathoner business with 10-plus years of smooth rising earnings, and a habit of reinvesting in itself. They sow and reap by spending on R&D or expansion to fuel future growth. These clues hint that the company can compound value over time. In other words, the best stocks might actually seem a bit boring, steadily growing, consistently profitable, and not constantly in the headlines. Graham even dives into management quality. Do the top execs own up to mistakes, or do they blame the economy or other excuses? Are they shareholder-oriented managers or just stock promoters, hyping their stock price? For example, if management is drowning investors in stock options, diluting future earnings, or using opaque accounting, that's a bad sign. The intelligent investor should seek businesses run by honest, accountable people, because in the long run, that integrity, or lack of it, shows up in the results. By the end of Chapter 11, the message is clear. Look before you leap into any stock. Use a rational framework, examine a company's finances, ask the right questions, and be wary of stories that sound too good to be true. This is Graham's antidote to the feverish speculation that grips the market from time to time. It's less flashy than following hot tips, but it's a heck of a lot safer. The Earnings Mirage. Beware per share. Pitfalls, Chapter 12. After teaching us how to analyze a business, Graham delivers a stern warning in Chapter 12. Things to consider about per-share earnings. In short, don't be misled by a company's earnings per share, EPS, at first glance. Here's what most people miss. A single year's profit figure can be dressed up like a doll, so don't take 1 year's earnings too seriously. And if you're going to pay attention to short-term earnings, be on the lookout for the booby traps hidden in those per-share numbers. What kind of booby traps? This part really opened my eyes. Companies have a bag of tricks to make earnings look better or more stable than they truly are. Graham and his commentator Jason Zweig enumerate a rogues gallery of accounting gimmicks that can distort the truth. 1. One-time special charges. Watch out if a company keeps declaring some expenses or losses as special and excludes them from operating earnings. If every year there's a new one-time write-off, those aren't one-time at all. It's a way to hide recurring failures. As Graham Riley notes, some companies get the bright idea to charge all losses to special items, report only the profits, and voila! Every year looks sunny. Zweig adds, investors must always count the sunny and dark hours alike. You can't ignore the bad stuff. This part blew my mind. Graham gives an example of Alcoa, which in 1 year anticipated future losses and lumped them into that year's results, effectively freeing future years from those charges and even creating future tax credits for itself. It's like sweeping all the dirt into one room and locking the door. The house looks clean after, but the dirt is still there. He calls it a nice arrangement, maybe good accounting or business strategy, but deeply misleading if you don't catch it. The lesson: don't let companies normalize away their bad news. 2. Dilution and stock shenanigans. A company might have issued tons of convertible securities or warrants, basically future rights to stock that can dilute earnings for existing shareholders. If everyone with stock options, convertible bonds, etc. cashed in, would today's earnings per share shrink? Often yes, sometimes by 50% or more. Also be aware of massive stock option grants to executives. A company might quietly buy back shares just to offset the dilution from management stock options. These moves don't necessarily improve the business at all, but they can artificially prop up the per-share earnings number. An intelligent investor checks the footnotes to see the fully diluted EPS and the effects of all those potential extra shares. 3. Creative accounting choices. Graham flags things like how a company handles depreciation, straight line versus accelerated, or R&D costs. Do they expense them all at once or spread out over years? And how they value inventory, FIFO versus LIFO. None of these are wrong, but different methods can significantly change reported earnings. Also, beware of pro-forma earnings. These are those adjusted, hypothetical profit figures companies publish to flatter their results. As if we didn't have all those expenses, look how great our earnings would be. Graham basically says, ignore pro-forma flim-flam, stick to real accounting earnings. And if you see too many buzzwords like restructuring charge, deferred expense, capitalized cost, etc., dig deeper. The company could be pushing expenses off into the future or otherwise massaging numbers. In essence, Chapter 12 teaches us that earnings numbers are only as good as the accounting behind them. If you don't analyze the quality of those earnings, you're walking into an illusion. Graham's advice is eminently practical. Use multi-year averages and long-term perspective to truly understand a company's earnings power. He suggests looking at 7 to 10-year averages of earnings rather than a single year to smooth out the cycle and include the bad years along with the good. This gives a more realistic picture of what a company can earn through thick and thin. He also points out an intriguing case. A company with a big loss in the past might actually boost future earnings because it can carry forward that loss to avoid taxes on future profits. So ironically, a terrible year could make the next few years look artificially strong, no taxes. Graham advises adjusting for that. Consider what the earnings would be with a normal tax rate, so you're not fooled by a temporary tax break. Always factor in a margin of safety in your estimates, he says, meaning be conservative and assume things won't always be perfect. To protect yourself from earnings tricks, Graham, and Zweig's commentary, give some practical tips. This is pure gold for a diligent investor. 1. Read the financial reports back to front. The ugly stuff gets buried in the back pages of an annual report. Start there to find any dirty laundry. 2. Read the footnotes to the financial statements, all of them. That's where the accounting decisions and hidden obligations live. Never buy a stock without understanding the footnotes. 3. Compare with a competitor's reports. If Company A is using aggressive accounting, a peer's statements might expose what's normal and what's fishy by contrast. 4. Look for code words that signal earnings management. Deferred, capitalized, restructuring, one-time, non-cash. These all warrant further investigation. They don't mean a company is uninvestable, but they do mean you need to ask, why are they using this accounting move? What would earnings look like without it? 5. Continuous learning. Graham implicitly encourages us to keep educating ourselves on financial reporting. Zweig even recommends books like Financial Shenanigans, a great read if you want to dive into the dark arts of accounting. The emotional takeaway from Chapter 12 is a bit of healthy paranoia. Trust but verify every glowing earnings report. It's empowering, actually. Instead of taking CEOs at their word, you learn to see through the numbers. As I read this, I felt a surge of confidence. The next time a company boasts record earnings, I'll know to peek behind the curtain before I cheer or buy the stock. Case study: 4 companies, 4 lessons, Chapter 13. After arming us with principles, Graham puts them to work in Chapter 13, a comparison of 4 listed companies. This chapter is a hands-on application of security analysis, kind of like looking over Graham's shoulder as he examines 4 real companies side by side. This part is awesome because it transforms the abstract ideas into concrete analysis. Graham picks 4 companies of his day: ELTRA, Emerson Electric, Emery Air Freight, and Emhart Corp., and evaluates each from the perspective of a conservative investor. He lays out 6 key elements of performance to compare. 1. Profitability. Are they good at making money? 2. Stability. How steady are their earnings over time? 3. Growth. What's the long-term growth rate? 4. Financial position, balance sheet strength, debt levels, etc. 5. Dividends, payment record and yield. 6. Price history, how the stock price has behaved over the years. He basically runs these 4 stocks through a checklist to see which hold up as sound value investments. It's a bit like a mini stock picking workshop, and it reveals a tension that's super relevant: the difference between a glamour stock and a value stock. 2 of these companies, Emerson Electric and Emery Air Freight, had fantastic growth and stock performance leading up to 1970, the kind of companies that get investors excited. As Graham notes, analysts would be very keen on them for 2 reasons: better market action, their stock prices had been skyrocketing, and strong recent earnings growth. They were the glamour pair. The other 2, ELTRA and Emhart, were more plain Jane: stable businesses, slower growth, not as thrilling in the market. They were the value pair: solid companies whose stocks were cheap relative to their assets and earnings. Now, here's where the conflict comes in. Graham essentially asks, which would you rather own, the high flyer that everyone loves, or the steady earner selling at a bargain price? Most people reflexively chase the hot growth stock. But Graham, true to form, leans toward the boring winners. He points out that reason number 1, hot stock price momentum, is not a valid reason for an intelligent investor to buy a stock. That's speculation, pure and simple. And reason number 2, high earnings growth, is good, but only up to a point. When a stock's PE ratio is 60 or more, even great growth can become a trap because when is high too high? In other words, if you pay an outrageous price for that growth, you're setting yourself up for disappointment. Graham issues a gentle warning. Don't commit the typical Wall Street error of over-enthusiasm for excellent earnings and a soaring stock price. That's how people get suckered at the peak of a hype cycle. So what did the analysis show? It turned out Emerson and Emery, glamour stocks, had indeed wonderful metrics: high profitability, fast growth, but they were also priced for perfection. Emerson, for example, had a lot of intangible assets boosting its reported value, goodwill from acquisitions, etc., which a cautious investor would eye with suspicion. Its stock was no doubt a market darling, but to Graham that was a sign to be careful, not a buy signal. By contrast, ELTRA and Emhart looked undervalued. Their stock prices were low relative to their book value. You could buy shares for about what the company's net assets were worth, a classic Ben Graham hallmark. And fundamentally, they passed with flying colours: strong return on invested capital, stable earnings for many years, and decent growth history. In fact, Graham is pleased to note that both ELTRA and Emhart check all 7 criteria he later lists for defensive investors. Things like a solid size, 20 years of uninterrupted dividends, no earnings deficit in the past decade, a moderate PE ratio, etc. Essentially, these 2 were prime examples of value stocks, not flashy, but built on rock-solid fundamentals and selling at a fair price. He sums it up with a powerful point. Choosing the safer value stocks, ELTRA and Emhart, over the hyped glamour stocks, Emerson and Emery, comes down to your philosophy. If you prefer real value over speculative promise, you'll lean toward the former. As Graham puts it, the intelligent investor's sound basis for preferring ELTRA Emhart is that you're deliberately opting for value-type investments instead of glamour-type investments. That line gave me chills because it draws a line in the sand. Are you investing or speculating? To drive the lesson home, Jason Zweig's commentary updates the story of Emerson Electric. He shows that even decades later, the same principles hold. Emerson continued to be an outstanding company. By 1999, it had increased its earnings 42 years in a row and raised its dividend 43 years in a row. Think about that. Through wars, recessions, booms and busts, this boring industrial company kept delivering higher profits like clockwork. Yet, during the late 90s dot-com bubble, Emerson's stock underperformed the market by nearly 50%. Why? Not because anything was wrong with Emerson, its sales and profits were hitting records, but simply because it wasn't a cool internet stock. The market was obsessing over unproven tech darlings, and a profitable blue chip was considered too boring. This blew my mind. A rock-solid business was practically ignored while investors chased fads. But guess what? When the tech bubble burst, it's the Emersons of the world that survive and thrive. The moral here is profound. The crowd can go crazy, but if you've done your homework on value, you can keep a cool head and eventually reap the rewards. Chapter 13 thus serves as a vivid illustration of everything from chapters 11 and 12. You see how to evaluate real companies using Graham's metrics, and you see how the flashy stock isn't always the best investment. It's emotionally engaging because it's real money and real companies. You can almost feel the temptation of the hot stocks and the solid comfort of the conservative picks. Graham is basically saying, I know it's not sexy to buy the boring stocks, but look at the data. This is how you avoid the grave mistakes. Conclusion: value over hype. The one powerful message. Benjamin Graham once said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. These chapters hammer that truth home. The one powerful message tying together chapters 11 to 13 is this. Investing is most intelligent when it is most businesslike. That means doing your homework, valuing substance over story, and never forgetting that behind every stock ticker is an actual business with an intrinsic worth. If you internalize these lessons, you'll cultivate a kind of emotional discipline that most investors lack. You'll stop stressing over daily stock fluctuations or one-year earnings blips. Instead, you'll focus on long-term averages, real profits, and a margin of safety in what you pay. You'll remember that a glamorous growth story can seduce the masses, but it's the steady, undervalued businesses that make for safer and often superior investments. You'll be willing to be patient, even contrarian, like buying great companies when they're out of fashion, as Emerson Electric was in the late 90s, and avoiding the flavor of the month stocks that everyone else is piling into. Most importantly, Graham's approach saves you from the big life-altering mistakes. The overpriced purchases, the blown-up portfolios from chasing hot tips, the disillusionment that causes people to quit investing altogether. He's giving us a roadmap to build wealth steadily and sleep soundly at night, knowing we're invested in solid enterprises bought at reasonable prices. It's not a get-rich-quick scheme, it's more like get-rich-safely. At the start, I said, this could be the most valuable 25 minutes of your investing life, or just background noise. And I meant it. Those 10 years are the ones most investors spend making painful, expensive mistakes. Chasing hype, falling for bad advice, and learning everything the hard way. But Benjamin Graham already made those mistakes for you. And in this video, he's handing you the lessons refined, tested, and laid out like a blueprint. The only way this video actually wastes your time is if you nod along, feel inspired, and then do nothing with it. But I don't think you will. If you're still here, you're already ahead of the crowd. You're more thoughtful, more curious, and more disciplined than the average market gambler. And now you've got Graham's wisdom on your side. Here's what I found. The core of the intelligent investor, especially these chapters, is an emotionally resonant, almost philosophical stance. True investing requires humility, patience, and rationality. It means caring more about what a business is worth than what the market says it's worth today. If you embrace that mindset, you protect yourself from the seductive but dangerous games of Wall Street. In the end, the message is inspiring. By investing with courage and conviction in real value, you can achieve financial success while avoiding most of the heartbreaks that befall reckless investors. That's a powerful promise. And for me, it absolutely blew my mind how relevant these 70-year-old lessons remain. They might just save you a decade of mistakes and set you on the path to lasting wealth and financial wisdom. The intelligent investor has given us a masterclass in sanity. Now it's up to us to use it. Let the other folks chase the rainbow. We'll be over here weighing the gold.